Know what you own and know why you own it. Peter Lynch transformed that advice into a playbook that shielded billions at the Magellan Fund. Yet, most investors who chase the market miss the 10 risk management rules that kept Lynch ahead. And ignoring even one can devastate your portfolio. Which disciplines can you actually use, and which costly mistakes still lurk beneath the surface? Peter Lynch's first rule starts at the desk, not the trading screen. Before buying a single share, he insisted on writing a one-paragraph story that explained exactly what the company does, how it makes money, and why it could grow. Know what you own and know why you own it. That line, printed in bold on page 42 of his book, wasn't just a slogan, it was a test. If you couldn't summarize a company's business in plain language, you had no business owning its stock. Lynch believed the average investor's edge came from everyday life, noticing which stores are packed, which brands friends and family talk about, which products fill shopping carts. He once spotted Hanes as a winner after his wife raved about Legs pantyhose at the supermarket. But he didn't stop at the checkout line. He dug into Hanes' financials, checked market share, and only then wrote his investment story. Invest in what you know, Lynch repeated in interviews and on page 21 of his book. But he warned that knowing the brand isn't enough. You must also check the numbers. Observation is just the spark. The next step is discipline. Lynch managed the Magellan Fund with hundreds of stocks, but he never let a single position dominate the portfolio. New ideas started small, often capped at 2% of the fund's total value, unless deep research justified more. This guardrail protected against devastating losses if a story went wrong. At Magellan's peak, even standout winners like Hanes rarely grew beyond a few percent of the fund at entry. Diversification wasn't about owning everything, it was about never letting one mistake sink the ship. Lynch's approach turns curiosity into action. Write your own one-paragraph story for each stock, spot ideas from daily life, and set a strict cap on new positions. These small habits form the backbone of surviving and thriving in the market. Sorting stocks is not just a matter of preference for Peter Lynch. It's the backbone of how he managed risk and stayed disciplined. He broke the market down into 6 distinct categories. There are slow growers, the old giants that pay steady dividends but rarely surprise. Stalwarts are big names like Coca-Cola or Procter & Gamble, marching ahead at a steady 10 to 12% a year. Fast growers are the rocket ships. Small companies expanding at 20% or more, but with a wild ride attached. Cyclicals like car makers or airlines rise and fall with the economy. Turnarounds are the battered companies clawing their way back from the brink. And asset plays are the hidden gems, companies sitting on undervalued real estate or forgotten patents. Lynch insisted that every stock in a portfolio should be tagged with its category right from the start. This wasn't just for neatness. The category tells you what to watch for and how often to check in. Fast growers and turnarounds demand constant attention. One bad quarter and the story can unravel. Stalwarts and slow growers, on the other hand, can tick along for years, but even these need a regular checkup. He warned against one of the market's oldest traps, buying a stock just because it's fallen. On Wall Street Week in 1982, Lynch put it plainly, "I do think people buy stocks because they've fallen from price X to 2/3 of X or half of X on that basis alone. They're buying a stock that's called bottom fishing in the stock market." Very, very difficult. Chasing a bargain without a real story is a quick way to lose money. Selling for Lynch was never about nerves or market noise. He kept a checklist tied to the company's original story. If earnings fell sharply, if debt ballooned, or if the business changed in a fundamental way, that was a reason to exit. But if the story held, he stayed put, even when headlines screamed panic. "The key to making money in stocks is not to get scared out of them," he wrote. By classifying every holding and setting clear rules for when to sell, Lynch gave himself, and anyone following his method, a sturdy defense against emotional decisions. These habits build the discipline needed to survive the market storms and avoid watering the weeds while cutting the flowers. Valuation discipline stands at the core of Peter Lynch's risk management playbook. Before adding a fast grower to his portfolio, Lynch insisted on a margin of safety, anchored by a simple formula. The price to earnings ratio should not exceed the company's growth rate. In his words, The P/E ratio of any company that's fairly priced will equal its growth rate. For Lynch, a PEG ratio near 1 meant fair value. Anything much higher, and the risk of overpaying crept in. He didn't set a hard ceiling, but he kept a PEG band as a guardrail, especially for fast growers. This habit forced investors to run the numbers, not just chase stories. A spreadsheet with PEG ratios, updated before every buy, helped keep emotion out of the decision. Forecasting the market, on the other hand, was a trap Lynch refused to fall into. In a PBS interview after the 1987 crash, he put it bluntly: people should think about what is happening, not predict the future. He believed that most investors wasted precious time on economic predictions that rarely paid off. His advice was sharper still in another famous line: if you spend 13 minutes a year on economics, you've wasted 10 minutes. Lynch watched company earnings, industry trends, and real-world signals, never GDP forecasts or interest rate guesses. He urged investors to focus on what they could actually know and control, not on the noise of macro headlines. Leverage, to Lynch, was a line never to cross. Using margin amplifies both gains and losses, but it also introduces a risk that can wipe out years of careful work in a single bad week. Lynch's approach was clear: avoid margin entirely, or use it so sparingly that a sudden drop would never force a sale. He preferred to toggle margin settings off at the brokerage level, treating borrowed money as off limits for most investors. This rule kept emotions in check and protected portfolios from the kind of amplified downside that ends investment careers. For Lynch, risk management wasn't just about finding winners, it was about building habits that kept investors in the game, year after year. Liquidity is the silent risk that can turn a smart investment into a forced mistake. As a Magellan fund ballooned into the billions, Peter Lynch faced a problem most individual investors never see. Some stocks were simply too thinly traded to touch without moving the price. But the lesson applies at every scale. Never buy more of a stock than you could sell in a calm market. While modern fund managers often cap positions at 1% of average daily volume to avoid trouble, Lynch focused on practical liquidity, favoring companies with active trading and steering clear of illiquid traps. For the everyday investor, this means checking the trading volume before sizing up a position. If it would take days to exit without moving the price, the position is too large. This habit keeps portfolios nimble and prevents the panic of being trapped when the story changes, but risk management doesn't stop with the buy or sell button. Lynch believed that vigilance was a monthly ritual, not a yearly chore. He kept a running spreadsheet for every holding, tracking 3 key metrics: earnings growth, debt levels, and any change in the company's core business. Each month, he would scan for surprises: a sudden dip in revenue, a spike in debt, or a news headline that didn't fit the original story. If the facts changed, he didn't hesitate to update his thesis or cut the position. Lynch's research style was relentless and humble. In 1993, he put it simply: the person that turns over the most rocks wins the game. This wasn't just about finding new ideas, but about constantly re-examining what you already own. The best investors aren't the ones who guess right once. They're the ones who catch small changes early before they become big problems. A monthly checklist, a quick glance at the numbers, and a willingness to dig deeper. These habits keep a portfolio healthy long after the initial excitement fades. For Lynch, survival in the market came down to this: stay liquid, stay curious, and never stop turning over rocks. Between 1977 and 1990, Peter Lynch managed the Magellan Fund to an average annual return of 29.2%, a record grounded in strict risk management. This documentary has shown how Lynch's 10 rules, sourced from One Up on Wall Street, and his public interviews, emphasize knowing what you own, sizing positions carefully, and never using margin. His 6 stock categories and PEG ratio discipline remain cited in investment literature today. While Lynch's precise sell triggers and liquidity thresholds have evolved with changing markets, the core principle, vigilant, ongoing research, endures. Some details about his day-to-day decision-making remain unpublished, and the market's future risks are always uncertain. But Lynch's documented framework still shapes how investors think about risk. As he said in 1993, the person that turns over the most rocks wins the game. These rules, backed by evidence, offer investors concrete tools to navigate volatility and focus on what they can control.